How much does the lack of data factor into what your views are or are not?
Well, so we do have a lot of information about the labor market, in particular the labor market. There's a lot of private sector data, there's surveys. What we're missing is the core of the data, not having the federal statistics, not having the employment report, household survey, particularly a measure of unemployment. And it's, you know, the timing is really unfortunate because, again, as you noted, it's the Fed began reducing rates again because it is concerned that the labor market would be deteriorating and that you could have these slow job creation that we've seen turn into actually a contraction in jobs and then potentially a recession. So they're really wanting to get a sense of the momentum, and that's when some of our key statistics went dark. And I mean, this, you know, the disruption of data is probably going to last even after the government reopens. So, you know, I think that piece of like, what does Powell tell us about how are their assessments of the risks around employment and inflation changing or not changing? Probably today he can still point back to September. Things are largely as they were. But I think part of that is the fact that they don't have the data that they'd be confident enough in to kind of change the story, say, hey, the labor market's getting better, or really double down on it's getting a lot worse.
Claudia, you're perhaps best known, you know, for this idea that you have a methodology, a construct by which you can signal a possible recession before the GDP data actually confirms so. So with the data that you have and what you do not have, can you tell us whether or not America is in a recession or not?
Well, I can tell you that the recession indicator that I have isn't well suited to this moment. So in that it's looking at changes in the unemployment rate, and we know when there are big swings in the labor force, in the supply of labor, it can create changes in the unemployment rate that aren't the kind of changes we see in recession. So last year, the recession indicator actually triggered, and we had a big period of, you know, particularly from immigration, but also labor force participation. We'd had a big increase in the labor supply. So that was kind of pushing up the unemployment rate, but for a good reason, because people are out and they're getting jobs, and it came back down. And now the indicator is at 0.1 relative to a threshold of 0.5. So if you just looked at that, you say, oh, we're nowhere near, you know, being in a recession. But I would say that right now we have the opposite of immigration has really slowed, and we've got a labor force growth that's slowing, and that actually can push down on the unemployment rate. So I think this is one where some of our typical rules of thumb, I mean, a lot of them broke during the cycle at various points, but I also think right now, again, when we have these big movements in supply, it's much harder to read our statistics, and then we don't even have the statistics, right? I can't even give you the updated version of my indicator because we don't have the unemployment rate for September.